I remember when I first started earning money and my account balance slowly started to increase as I started saving more money. I first hit the $1,000 milestone and then the $10,000 milestone, and it kept increasing as I kept working and earning more money. And every time I hit one of these new milestones, I used to make sure that no matter what happened, I don't fall below this number. Say I had $10,400 in my account, I used to make sure that no matter what happened, I don't spend more than $400, otherwise I'd fall back into 4 digits and I'd feel broke. The next milestone I hit, say $20,000, I used to try to do the same thing. It was some kind of mental block. Having excess cash in my account used to make me feel safe and validated. I wasn't really thinking about how much of that money I needed for next month or for the next year or for emergencies or how much of it I could invest for the long term. I just enjoyed seeing my account balance increase. Turns out staring at all this money piling up in my account wasn't the best idea. Don't get me wrong, we definitely need to keep some cash in our account. And I've spoken about why we need to keep emergency funds, short-term expenditure and medium-term expenditure in cash. And I'll link that video in the comment section below. But in this video, let's go through why holding excess cash, especially over a long period of time, can be extremely detrimental to your hopes of growing your net worth. Let's get started. The first reason why excess cash is bad is because cash loses value over time due to inflation. Inflation is the decrease in purchasing power of money over time. What that means is $1 today is worth less than what $1 was worth 10 years ago. And $1 10 years from now is going to be worth less than what $1 is worth today. Because the worth of $1 or any other currency, or the purchasing power of $1 or any other currency, decreases over time. The higher the rate of inflation, the faster the purchasing power of money is decreasing. Say the inflation rate is 5% and your shopping costs you about $100 today. That means your shopping would cost you about $95 a year ago. And if inflation stays at 5% for the next year, the same shopping will cost you $105 a year from now. If the inflation rate stays at 5% for the next 10 years, the same shopping will cost you $163 10 years from now. The average inflation rate of the US dollar over the last 20 years is about 2%, and the average inflation of all currencies globally ranges from 3 to 5%. That means the money you hold in your bank account is losing value at anywhere between 2 to 5% every year. For some currencies, it can be more than this. For some currencies, it can be less than this. But for an example, let's assume you hold $10,000 in your bank account for the next 20 years, and we assume inflation stays at 2%. Well, then that $10,000 in 20 years is going to be worth approximately $6,700 in today's money. It's still going to be $10,000, but because the purchasing power of money has decreased over time, that $10,000 will only be able to buy you what $6,700 can buy you today. So what this really shows us is that cash is a depreciating asset. And while we can invest our cash to grow our wealth over time, holding on to excess cash for a long period of time can actually decrease our wealth over time. The second reason why excess cash is bad is because cash generates a very low return. Cash falls at the bottom of the risk-return trade-off graph. And though it might make you feel safe because it's risk-free, cash generates close to 0% return. Holding a large part of your portfolio in an asset that generates no return decreases the portion of your portfolio that actually helps you generate a return. If you're in your 20s or 30s, this is the time to invest as much cash as you can in assets that generate potentially high returns. So try to hold as little cash as you can in your portfolio right now, so you will have more cash to work with when you retire. This is the time to put more money into relatively riskier assets and not the time to hold a large portion of your net worth in very low risk assets like cash. Don't hold on to excess cash waiting for the market to fall so you can buy the dip, because there's never a perfect time to get into the market and you could end up holding too much cash for too long. Remember, time in the market always beats timing the market. Let's go through an example to see how much of a difference holding excess cash can make to our net worth over time. Two of our friends, Mill and Neil, are both 25 years old. Let's say they've both reached their emergency fund target of $10,000. They both earn a post-tax income of $2,500 and spend 80% of this on their short and medium-term expenditure. They save the remaining 20%. Mill invests the entire $500 he saves every month, while Neil invests only $250 of the $500 he saves every month and puts the remaining $250 in his account balance to see his account increasing steadily. Let's say they keep doing this until they're 45 years old and they generate a 10% return on their investments. Well, at 45, Mill is still going to have $10,000 in his account, but his investment portfolio would have grown to $380,000. Neil's account balance, on the other hand, would have grown to $70,000, but his investment portfolio would only be $190,000. Mill's net worth is now $390,000, while Neil's net worth is only $260,000. Neil's net worth is $130,000 less than Mill's net worth because he held on to excess cash for too long. If this still doesn't convince you and you still want to hold on to extra cash because you're naturally a conservative investor or you're not ready to invest in the stock market yet, well then take your money and keep it in a high interest savings account, money market fund, or fixed deposit. Doing something like this will increase the amount of interest you earn on your money, and though it won't help you grow your wealth over time, it'll at least reduce the impact of inflation on your cash reserves and make sure your purchasing power doesn't decrease over time. So in summary, not all cash is bad. It's important to keep your emergency funds, short-term expenditure, and medium-term expenditure in cash because you don't want to be forced to sell your investments at a lower price in case of an unforeseen event or for short or medium-term expenses. But excess cash is bad because cash is a depreciating asset because of inflation and it gives you close to 0% return. If you're still not ready to invest your cash, keep it in a high interest savings account, money market fund, or fixed deposit so the purchasing power of your money doesn't decrease over time. I hope you enjoyed this video. If you did, do like the video. If you're definitely not looking for financial advice, do subscribe and I'll see you in the next one.